What are retained earnings in an S Corp? Have you ever wondered what retained earnings mean for an S corporation? Understanding this concept is key for small business owners. Retained earnings refer to the profits that an S corporation keeps within the business after covering all expenses and obligations. This includes any distributions made to shareholders. Unlike traditional corporations, S corporations are pass-through entities. This means that the profits are taxed at the shareholder level, not at the corporate level. In an S corporation, retained earnings are tracked differently than in a C corporation. Instead of a typical retained earnings account, S corporations utilize an accumulated adjustments account. This account keeps track of profits that have not been distributed to shareholders. The accumulated adjustments account reflects income that has already been taxed at the shareholder level. This allows the corporation to retain profits without facing additional corporate taxes. Now, let's talk about the tax implications. Shareholders are responsible for paying taxes on the corporation's profits, whether those profits are distributed or retained. This means that even if the corporation keeps profits in the business, shareholders must report and pay taxes on those earnings through their personal tax returns. When an S corporation decides to distribute profits to shareholders, those distributions are generally not taxable. This is because shareholders have already paid taxes on the income. However, if the corporation distributes more than its current year profits, it may draw from accumulated earnings and profits. This could trigger dividend treatment for tax purposes, which is something to be aware of. Managing retained earnings in an S corporation also involves practical considerations. It is essential to accurately track the balance of the accumulated adjustments account. This helps ensure compliance with tax regulations and avoids confusion with traditional retained earnings. Business owners should also consider cash flow needs, future expansion plans, and personal tax situations when making decisions about retaining or distributing earnings. If you are transitioning from a C corporation to an S corporation, the retained earnings accumulated under C corporation status will become part of the S corporation's accumulated earnings and profits. This conversion can have tax implications, such as potential built-in gains, tax if appreciated assets are sold within 5 years of the conversion. Careful planning and record-keeping are vital to manage these tax implications effectively. In the context of small business taxes and S corporation accounting methods, understanding retained earnings is essential for managing profits effectively. It helps ensure compliance with tax laws while aligning business goals with personal financial situations.